Everyone, thank you for joining us for today's webinar. I'm Hui Jing, Head of Partnerships and Investment Management. Thank you especially for you taking time off after work to join us for today's seminar. So over the past few years, we have actually seen that, markets have been actually fast changing. Uncertainty has actually become constant, especially in financial markets. Over the past few years, we actually went through COVID. We also went through Russian-Ukraine war and recently Trump tariffs. That has actually triggered sharp market swings. That has actually added an additional layer of complexity for investors. But while the headlines are unpredictable, your investment strategy doesn't have to be so. That's why we're here today to share with you how you can approach investing with confidence even in turbulent markets. So before we start the presentation, can I draw your attention to the next slide, whereby we share with you the disclaimers. Please take note that the slides that we're presenting today are only for reference and not meant to be relied upon for legal interpretation or advice. The information is also not an offer or solicitation of an offer for any financial products. The information contained herein does not have any regard to the specific investment objectives, financial situation, or particular needs of any person. So please take note of that. So at MoneyOwl, we believe in empowering individuals with trusted professional financial advice without direct selling. So because of what we have actually seen in the markets recently, because of Trump tariffs, we have actually launched a number of videos as well as webinars to handhold investors to make smart decisions in times of uncertainty. We also have a website whereby you can also access via www.moneyowl.com.sg to find out more about making investment decisions through checklists, curated solutions, and simple decision-making rubrics to help you making confident financial decisions. And don't forget, you can also follow us on our Instagram for bite-sized financial tips. So moving on to the main agenda of today's evening, whereby we'll have Chuin Ting Weber, our CEO and CIO, to share with us how should we invest through uncertainty, followed by Q&A at the end of the presentation. So you can put through your questions through the Q&A button at the end of your screen so that you can actually send the questions in and we'll take the questions after the presentations. So without further ado, I'll hand it over to Chuin Ting, who'll be sharing with you how to invest through uncertainty.
Yeah, thanks, Hui Jing, and thanks everyone coming in to join us this evening. Hope that you're having a nice dinner. Don't worry, I'm not CNBC, so you're not going to puke when you see what's happening in the markets. And in fact, what has happened since the last 2 weeks, already maybe even just 1 week, when we're talking about tariffs, is every day is a change. But maybe first, in a nutshell, the key takeaways we have from this tariff situation are as follows. In terms of what is likely to come, we can only say that it's going to be continuing unpredictability. For Singapore, there's consensus that poor growth, that means the impact on your jobs, on businesses, on income, are likely to be the greatest concern rather than inflation pass-through for this moment. Let's have some perspective when we look at tariffs. There are enough guardrails, resources, and just about enough sense to stem a sudden full-blown financial systemic crisis, in our opinion. But the larger structures of trade, global financial system, reserves will adjust over time. What's the strategy that we propose to you is to keep focused on what can help you through uncertainty, through the various scenarios, rather than trying to predict the most likely scenario. There are two general attitudes here that will serve us well. One is self-awareness. This is a very good time to reassess what our true risk appetite is, our willingness, our ability, our need to take risk. And we need to get our basics right. Invest only in what you really can stay invested in and not what is the most attractive in terms of headline return and what you can do without stress. And the other part is the attitude of sufficiency. We've always advocated that let's average out all your bets. Average it out in terms of timing, average it out in terms of what you buy, diversification and dollar cost averaging, especially very important for this kind of markets. And I'll show you why. Okay, so let's see what really has happened. Well, every day is a new day. It is predictably unpredictable. So we had that Rose Garden tariff a table, and then we had a 90-day pause, which was when we did our second video, and suddenly China is on, China is off, some things are spared, some things are not, and then the Fed chair's job seems to be on the line, and thereafter apparently he never said that. I think today there was a few other things about who is supposed to make the first move on tariffs between US and China as well. In this kind of gyrations, there's an interesting idea of what is happening, and this is from BCA. BCA is a research house, and they had their geopolitical analyst, and it's quite interesting here because it says that Trump seems to follow a certain rule book or a certain rubric when it comes to how he makes deals. And first he asks for the moon, and it comes with wow, the most maximum request, and then he presses that big button and say, I'm going to press this big button, and then someone gets punched in the mouth because nobody really believed he would do it, and on 2nd April he did it. Thereafter, make friends. So of course we saw that also in Singapore actually play out in the Kim Jong-un and Trump meeting. So wow, that's great. But then he was left at the altar. It was off again. Number 6, then it's on again, and something happens, and then a deal is made. I'm not sure what you think about this, but it's interesting. And what we're therefore seeing is that it is not the sort of normal, rational, or traditionally rational way of doing things, but quite a different way of geopolitics, which results in extreme volatility and uncertainty. The impact on the economy, as we've seen, is undeniably going to be very negative. So the IMF had just released its growth forecast for the world for 2025 2 days ago, and global growth forecast was downgraded quite significantly to 2.8%. This is the lowest since COVID and the second worst since 2009, which is the year of the Lehman crisis. And the probability of recession, the global recession probability, has been increased to 30%. This is a very negative picture. For Singapore, there are several orders or effects of tariffs, and there was always this idea, is it going to be growth or inflation or stagflation, or how does it work? The consensus now among economists is that the key pressure is deflationary, meaning that we are facing growth pressures from decrease in global demand. Now, in GDP growth, forecasts have been downgraded. Lower end is 0%. And in fact, first quarter, we already had a negative 0.8%. There was a contraction quarter-on-quarter seasonally adjusted GDP growth. So this means that if this next quarter is also negative, you're technically already in a recession. But it's not so much the technicals that matter, but what is the impact on jobs and income and basically livelihoods here. On inflation, the inflation forecast has been revised downwards by MAS. So this might be a bit surprising because when we talk about tariffs, you're talking about how this increases the goods that are sold to consumers. That is definitely true in the case of the US, but I think in terms of Singapore, the consensus is that first order effect might actually pass through lower growth and lower demand. So in Singapore, we're talking about less inflation. Now, less inflation doesn't mean, lower inflation doesn't mean that prices are not going up. It just means that they're going up more slowly, and also doesn't mean that price levels come down. So, but on balance, what is most important is growth, because we are a trade dependent economy, trades 3 times our GDP. So what the MAS has done is that it has used its exchange rate policy and reduced the rate of a Sing dollar appreciation against a basket of currencies twice in 4 months. It still is allowing some slight appreciation, probably to take into account the potential future second, third, fourth order effect that maybe there might be some inflation in some sectors or for some goods and services. What all this means is we have to really brace and tighten up our belts and think about how we can preserve our jobs, our income, and business owners as well will be under stress. that's the economic picture. What about markets? Well, in this case, where markets are scared, when things are unpredictable, you get what you call a normal behavior of markets, which is volatility. So you can see here in the chart that in the run-up in 2024 was a great year. It was a magnificent year, and magnificent year as well. US, the world went up, EM, emerging markets went up. In 2025, what we do see is a sharp sell down with huge swings up and down every day. So US is down the most, the global equities in general is down. Interestingly, emerging markets is up a little bit, but there are certain other factors. It's not just about the asset price, it's also about currencies, but more of that later. So the equity markets are behaving like you expect them to when there is such unpredictability and a threat of economic recession. Oil price, always to do with demand, whether there's demand for freight and all that. So that has fallen. It fell below the psychological $60 US dollars per barrel price. Now it's hovering around there. Gold, there was a flight to safety. Gold, if you had bought gold, you would be very happy about that. Of course, the question is, are you going to sell? Right. So across all currencies, but especially the US, gold has hit record high. But not all markets behaved normally in time of stress. During risk off, you expect the US government treasuries, a safe haven, the bond yields to fall. Now, on the first 2 days or first day, when after the 2nd April Rose Garden announcement, indeed, there was a very normal flight to safety in the US bond. And the US 10-year government bond yield went down to about below 3.9%. But thereafter, especially in the week leading up to 9th of April, there was a huge spike in bond yields. This means there's so many knock-on implications for everything. Bond yields are the base of which all corporate borrowing, a lot of corporate borrowing will be priced, and where stocks are discounted, and so much more hangs on this. And the US dollar has been extremely weak. Usually when there's stress in the markets, everybody buys US bonds and everybody buys US dollars. But a US dollar against its majors meaning like Europe, UK, sterling, and so on, have actually fallen by quite a bit. So is this time really different? Because in all the other crises that Hui Ting talked about, COVID, before that we also had European debt crisis and all that. This was not the case. In fact, for the longest time, we even had very, very low bond yields, and US dollar strength was quite decent. So if the very foundation of financial markets and the global financial system, the US dollar, is being threatened, then is this time really different? And this is the key worry for investors, that everything's going to collapse and stay down at quite a different level. So the question is that even as we look at a chart like this, where there are average months of expansion and recession that you see in the middle, and then the average annualized performance of the stocks. And we see that no matter whether it's green, which is an expansion, the orange, which is a recession, you have, the stock market going up in general, and you end up in the long term with a very good return. So is this just another business cycle? Is the very currency and the countries in which this stock market chart is based on, which is US S&P 500, can it actually survive our system? Or is it going to be one of the very scary ones, the bear market, the Great Depression? Now, we'll go slow on this slide. This is the about 16 bear markets that you have in the US, and we're talking about the declines in the US stock market. So if you look at the first line, this is the Great Depression. If you were so unlucky as to buy it at the height of the market during that time, 3rd September 1929, you could have experienced up to an 84% decline. And this would happen over 845 days, which is about 2+ years. And it took another 12 years or so to recover. So that's why in my previous webinars, we always talk about, do you have a 15-year time horizon? And after 10 years, you look at your annualized return. So basically, over this long time, this is not the total return, it's the per year compounded return was still negative. In other words, you would still be in the red. After 15 years, you'll be just about in the black, but it's not a very good return, is it? So this is actually risk. This is what happens when you want to participate in growth. You have to take some risk. So the question really is that, given the kind of stresses that we are seeing today, what kind of bear market are we in particular? Are we looking at as bad a situation as the Great Depression? After all, the last tariff war, the Smoot-Hawley Act and all that also was tied to the Great Depression. Of course, we have a few others here, and the numbers show that there is no pattern to whether you have how long or how deep recessions or rather bear markets can be. And that means when declines are more than 20%, we call that a bear market. How long, how deep, we do not know. So are the US dollar foundations of the world being shaken? This really should not have happened. This deal spiking up in those few days leading up to 9 April should not have happened. In the financial markets, we as financial professionals, we don't generally look at stock markets. The stock markets are, we have a lot of animal spirits, things move very fast. We don't look at that for signs of stress. It's always the bond markets. I still remember that few hours that day that in Singapore was, I think it was 8 or 9 April, was very jittery, and a few hours were texting each other and saying, what's happening? What's happening? Why is the US bond yield so high? And I think we know now that it came very, very close to a systemic risk. The Fed almost had to step in. And this was what triggered President Trump to walk back and have a 90-day pause. So that in itself gives us some comfort that the bond markets can still have that power to discipline even administration like Trump 2.0. And bond markets being undefeated mean that we can have some hope that at least there's enough sense or enough people around in the administration who care about this. And of course, this is also what happened with the frustration with Fed Chair Powell, because if the Fed Chair does not step in to do something on interest rates or on one year, it wasn't coming down. But when Trump said, maybe I'm going to fire him, wow, the bond markets and also the stock markets reacted so badly. And again, we believe that's why he had to walk back. So the respect that we still have for the bond market, at least some of it gives us some comfort. The central bank is the lender of last resort, is also the buyer of last resort. And it has proven that it's willing to do so throughout the last few crises. Governments as well, during COVID, for example, pumped fiscal stimulus around the whole world, including the US. And we believe that's why the US was facing relatively high inflation just prior to this year. And of course, liquidity, they lend to any bank that's needed. So when there was a Silicon Valley Bank had an issue, in the end, to safeguard the system, there was lending of US dollars to all, liquidity was pumped into the entire system. And of course, this follows the playbook in 2008 when there was also the Lehman crisis and liquidity was there, and of the bond purchases. Now, purchases of asset-backed securities, mortgage-backed securities even, and not just treasury bonds, but the Fed actually purchased loads and loads of treasuries and held them on the balance sheet. The Federal Reserve is able to print money electronically to buy US treasuries and to put down yields. And this is actually also what the Japanese central bank has been doing for ages. So that is a comfort as well. And post-depression, 1930s, there was a recognition that it was the problem of the central banks not coming in early enough that caused the Great Depression to be so deep and so long. And so everyone is wired to take action. And that is good news for us. As a result, you can see, if you go back to the chart that I showed you just now, downturns since 1930s have not been so long. the base scenario on US dollar, I would suggest to you, a lot of people have been talking about, US dollar is screwed, the bond yields are going up because people are selling. Is China going to weaponize it? Is Japan going to weaponize US dollar in terms of saying that, okay, you want to do tariff me, I will sell US dollar and sell US dollar and sell US treasuries to make bond yields go up, so you can't afford that, and mortgage rates will also go up. Yeah, so but the base case scenario is that if I suggest that this loss of dominance has already been happening, it's not easy to dethrone a reserve currency. A reserve currency is like the world's bank, like where you choose to put your money in, and so you can treat it that everyone is putting it in US dollars. And who was the reserve currency before US dollar? It was actually the sterling. Right? The sterling, but with the with the decline of the British Empire after the war, it lost its reserve currency status, but it took time to do that. And you see that actually over quite a number of years, 7 years or so, we already had this chart on the left that the central banks have been reducing the percentage of the currency reserves that are kept in US dollar. Now, please take note, this is not that they are not buying or that they are selling. They're in fact still buying. It's just that the rate of buying is slower. So if you take a look at the next chart that we have, okay, but that's the movement. Let's take a look at the actual stock. US is so way above everyone else. Where's Euro? No, it's about 20%. Where's Chinese yuan? 2%. So it will take time for this to happen. So like I said, people are still buying US treasuries. They're just buying them more slowly. But interestingly, actually, US is not a AAA rated country. Singapore is AAA rated country, but people still buy US dollar, US treasuries. Why? Well, it is a reserve currency. To weaponize this, it would be mutually assured destruction. You see that these major foreign holders of US treasuries, you have Japan, over 1 trillion, China, about 800 billion. Now, all these are being held a lot by pensioners, pension funds, insurance funds, and all that. If you sell down anything quickly, the prices will fall. So then what happens to the value of the rest of your reserves and your pensioners' money? So this is not something that I suggest to you, is not something that's going to be a base case. And domestic holders actually hold more US treasuries. The Fed has been slowly trimming, but it still holds about 3 trillion of US treasuries. And like I said, they can easily print money and buy them. So in the short term, of course, we can't say never, but in the short term, it will take time. There is no alternative, Tina. There is no alternative. There's nobody ever close to the US dollar, and you're not going to shoot yourself in the foot by just dumping US treasuries. So perhaps there's a threat of doing so, but I think we can have some faith that, I say some comfort that we will be doing okay on at least stemming, at least not really like hurtling into a systemic crisis or this. So yes, is it different this time? It is, because we are talking about a structural shock to the US dollar. But I always like to suggest to you again that we have had a lot of these things that felt like an Armageddon. In fact, in the 30s and later on, it felt very, very bad. But you also have US dollar. US dollar, you used to be able to exchange it for gold. The your US dollar note, you actually go to and exchange it in return for how much of gold. But there was the gold standard was abandoned. And was that structural? Yes, it was. What about in the 70s, when you have the what they call the oil crisis, when prices quadrupled? That was a real structural change. Black Monday, the Asian currency crisis, which affected Singapore, Thailand, that was a very, very bad situation for us. Then, of course, subprime meaning the Lehman crisis and the Europe debt crisis, all this, right? So yes, this time is different, but every time it's different for various reasons, because every time the market goes down, it's different set of reasons. But what has happened? Well, we've managed to survive so far. And why is this so? Why is this that the stock market, as an expression of capitalism, I guess, remains and over time goes up? Now, please bear in mind, I'm talking about the broadly diversified stock market. I'm not talking about any individual stocks or even any country, right? Stocks go up, prices of stocks, you own stock, you own part of a company, and ultimately over the long run, it's about earnings. So earnings in aggregate of all the companies in the world go up because aggregate demand tends to go up. What is aggregate demand dependent on, or what is it driven by? Population growth and the human quest for better living standards. And this is something human. This is something about us. Even as far back as in the 19th century, has already been noted that even when there's great devastation in a few years, people do bounce back. And we can see that in war and reconstruction as well. So yes, it's different. And what will happen then is the world will find a different way out. So PM Lawrence Wong had recently said that, yeah, there will be a new order. It will be more multipolar, less coordinated, more contested. But there will be a new order. And perhaps we manage to do it more quickly because of where we've been through and because of the world being more aware, nowadays, and the structures in some regions are better. And of course, in places like Singapore, I think we are blessed with having more resources to do this. So how do you invest through such uncertainty? You have the economic picture, and you also have a structural change that is going on. I think the principles of successful investing are actually evergreen, including in a volatile time that might go down before it goes up, or might just have a full recovery. We don't know, but it is so apply evergreen principles, but at the same time, you need to be more intentional in reassessing your risk profile. When you choose your investments, first is to determine what kind of general assets you're going to invest in. Is it going to be cash? Is it going to be equities? Is it going to be bonds, and so on? And there are three things that you need to take into account when you decide asset allocation. The first is your need to take risk. This is your required return. So let's say you are a retiree, and I have some friends like that, they have like millions and millions already, and they keep asking me, what am I going to buy? Should I buy? And all that. And they are really risk averse. So I ask them, actually, you don't need the money, right? You don't need any more money. And why do you need to take risk? Why do you need to take risk with it? If 2.5% in your OA is good enough, then why do you want to take this risk, right? So if you don't need the return, perhaps you don't need the risk. So we talk generally speaking about required return over the long term. I think that's true. But let's take a look at whether you really need to take this risk and what is your need to even do so. The second is a time horizon. Now, time horizon, sometimes in a very narrow sense or superficial sense, so we tend to think about it in the sense of age, but actually it's not true. It's a time horizon to your need to liquidate your assets and take this money and use this money. And the time horizon is your ability to take risk. But if you have a job loss, you actually are cutting short your time horizon. And so you need to reassess your ability to take risks in that light as well. So it's not just about age and goal. There's actually something in between. That's why we always say that have a good financial health, have an emergency fund, so that if you're already invested and something like that happens, you lose your job, you don't have to liquidate the excess assets that you already have, possibly at a loss, just to fund your expenses. Of course, if you do lose your job, what we do recommend is that you do not invest further and you stop your regular payments for now, because cash you need to preserve. The third is your willingness to take risks. So can you tahan this? Can you accept? Can you take all these gyrations? Now, we are in a very, very good situation now because the last month or so has been extremely violent and extremely unpredictable. How did you feel? What did you do? What were you tempted to do? Could you sleep at night? Please take an honest look at yourself. If you could not sleep at night, you you really were very unhappy and very stressed because all your money was in a very high risk, or say all in equities, and that disturb you, you cannot stomach the idea of a 50% loss over time, then your willingness to take risk is actually quite low. So reassess your need, ability, and willingness to take risk. And whatever investment decisions you make actually surround all these things. And this will then you must start from here. You shouldn't start from what is happening in the stock market. Is it a stocks good to buy or bonds good to buy? Because it depends on whether it's good for you. And whether something is good for you starts with this. What is your need to take risk, your ability to take risk, and your willingness to take risk, such that you don't stress too much. And then you find the right the portfolio allocation. That means how much bonds, how much equities, how much cash. And then you have to find the right type of things to express this and to invest in. And that's when we believe it should be a globally diversified set of instruments, funds. And then you stay invested in the right portfolio, in the right instruments. So these are the evergreen principles. And in such a volatile time when things go down and they go up and they go down and they go up, you have to reassess this risk profile more intensely. I had introduced this idea on this slide in my 10th April video, and says that for 3 groups of people, if assuming that your need, ability, and willingness is correct, and you have already been invested, then we say stay invested and stay diversified. Remind yourself, it's the time in the market, not timing the market. So if you are, say, 35 and you're looking at your portfolio to return you something when you retire, there's nothing changed about your need, ability, and willingness to take risk, then just don't participate in the fear and the watching of the market. There's really no need. But if you're not yet invested, or you want to think about it, then reevaluate all these risks, build more cash buffer, and prioritize dollar cost averaging and dripping in. Now, I'm going to make a strong pitch that in a bear market, or in this kind of volatile markets, that is really you need to practice this dollar cost averaging, because it's very important for both the psychological as well as the objective return, right? So here again, it's not what to buy, but how you go about buying it, right? Okay, so the third one is, if you are retirees or near retirees, actually you might not want to stay invested fully. If what you have is really sufficient, you can immunize it, prioritize how much cash you need, especially the next, say, 2 years or so. And then you can also reduce the amount that you are withdrawing from your portfolio every time. Now, I'm not going to, every month. I'm not going to go into this because please look at the video if you are interested. But I'll go on to say that the asset allocation, we have 5 portfolio allocations that we recommend according to your time horizon. And this can be found on our Invest. We don't actually sell anything, but we have worked with points with Philips Securities to make the funds available without any sales charge, of course, and also without any platform charges or advisory fees. So you can take a look there. And these are examples of the portfolios for the different risk profiles, the different need, ability, and willingness to take risk. But I would like to add an adjustment, right? So that you have your portfolio already, you have the time horizon. But look intently at your willingness to take risks. As I said, you might have that time horizon, you might have that 15 years. But if you really got scared and you're at that bottom right there, your extreme fear, of that greed and fear index, it's like you're traveling in this roller coaster, and not just any roller coaster, it's a roller coaster in the dark. I think if you have been to the Revenge of the Mummy, you go in, out. There's a part when the roller coaster go backwards, and you are all in the dark. And this is so terrible. So what you need to do is really, if you are really scared, you might as well move some of it to a lower risk portfolio. And why is that so? Because it's better than if eventually you just sell everything. It goes down 10%, you didn't sell. But if you don't have the risk appetite, when it goes down 30% and you sell, that's even worse. So I'd rather that, okay, you move some of it away. If actually your risk appetite is not there, especially if it is already enough for you. So, but try to have a buying back plan, right? Try to have a buying back plan. If you don't, then you are going to miss out on a lot when the markets do turn. In times of uncertainty, you do not want to put all your bets into predicting which scenario is correct. Instead, you take all scenarios and go by the power of averages. And this first thing that I would suggest you to average is to average up when you buy. So we saw this chart just now, and you say, wow, you know, if I had invested on 3rd September 1929, actually I don't make anything. Even if I stayed invested over my time horizon. That is true. But nobody said that you need to put your entire wealth in on the 3rd of September 1929, or today, or tomorrow, for that matter. That is the benefit of regular investing. Because think about it, if today for some reason was the peak, and you invested and it really went down 20-30%, you'll be buying lower and lower, and with the time horizon you ride up, you will make it all back when it comes up. And would your annualized return be higher or lower than what is reflected here? It will actually be higher or less negative. So when you do dollar cost averaging in this kind of market, it's actually beneficial because you're unlikely to suffer the worst experience. Now, on the way up though, there's another reason to dollar cost average, to average out your timing, which is this reminder that the market always leads the economy. It's always a mistake to try to read the economic signs to decide when you will go in. It will always feel too early. It will always feel very, very bad in the fundamental side. And this is true throughout all the last few crises. And even in terms of earnings, GDP, that is so. My next slide, I see that, you know, price bottoms, you've got 9 months. It could be 6 months, it could be 9 months, but in the past it has been 9 months. But how do you know in advance that you're 9 months ahead? You don't. So that's why if you dollar cost average, you are not taking big bets, but you're taking good, wise bets on the eventual recovery of the markets. Average your what as well, you know, and diversify. So what happens if you pick a stock? Let's say you pick so-called blue chips and darlings, right? Well, you got CDL there. It's still below its 2007 height. Of course, CDL has got a lot of news recently, but all these are very idiosyncratic risks, right? This is the nature of picking individual companies. You are subject to the very specific risk. Creative technology, once upon a time a darling, and it's never really recovered. Well, DBS is the opposite, right? DBS has gone up a lot. So if you pick the stock, you can win or you can lose. If you pick an index, you will win more often and you lose less often. But what if you pick the world? Perhaps that's another suggestion for you. Look at this. You have the green line was this over 5 years. Who was that green line? I think it will not surprise you. This in Singapore dollars. It was actually the US SPX index. But what's happened since the beginning of the year? The green line's at the bottom. And this is in Sing dollars. So you actually see that the top performer here in Sing dollars is the developed markets ex-US, and then followed by STI, I think. Yeah. So I'm not saying that you should go and chase them. In fact, I'm saying please don't chase them. But it's so many things affecting the returns, the relative returns of particular countries, even of particular stocks. Diversification, especially in times like this, when it's unpredictable, when the dice are being thrown like this, you need to not throw the dice, but buy the whole, be diversified and buy the whole world. So in summary, we need to have perspective, trust that the world will adjust, probably more quickly than a century before, because of what we've learned and where governments are, and hopefully less violently than it has been. Preserve first your basics, your jobs, your income, your near-term needs, especially retirees. Reassess, do you need to take this risk? Your ability, your risk tolerance, and accept a lower return option if it's better for you. Average out your bets on both when and what. Dollar cost average, diversify and aim not for the maximum return. Don't aim to like catch the bottom and you're not trying to impress anybody. Having enough is really not too shabby. So I think I come to the end of the presentation part, and we can move to Q&A portion.
Let me stop sharing the slides.
Yeah. So you have typed your questions, I believe, in the Q&A box, and
there are actually a lot of interesting questions. I was looking at the questions just now outside. So I think, Chuin Ting, you actually shared about, going to the markets, reevaluating your investment criteria, as well as, be more prudent, dollar cost average. But there are a lot of investors who are quite concerned about this current market situation. We have two kinds of questions. One is some very risk-averse customers are asking, should I sell everything that I have, hold in cash? Because Trump is so volatile, I'm not sure what is he going to say tomorrow. And on the other side, we have investors asking, should we actually take this opportunity to go into the market to buy? Do you think this is the right time to buy?
Okay. Yeah. So I think firstly for clients who are people who are quite risk averse, I think I would really recommend you look at your need, right? Your need really, that was what I'm saying. We are very used to looking at, say, is it a good time? Is it not a good time? Because we are listening to people who have to do that, right? Investment professionals and fund managers have no choice. They have to decide, is it a good time or, but they are playing a different game from you, right? Your game is the right game, is actually about whether or not it makes sense for you. So if you already have made a lot of profit and you are very worried and you want to hold it in cash instead and wait, well, the traditional financial advisor answer will be no. But if you cannot imagine taking a 20% down on this, and you will really kill yourself and also come and kill me if that happens, then by all means, but then have a buying back plan. Have a buying back plan that is so when things go up again, would you buy? And then again, drip in, and do that. So you can do that, but it starts from your need and whether what you can take, your risk ability, willingness to take risk. Yeah. As for whether it's a good time to buy, again, is my same answer, is that don't go all in or go all out. We are not buying property. You're not buying handbag. Yeah. So like I realized that Singapore investors have a bit of a tendency to say that, okay, I want to get it right and I want to like buy all in one go. You don't need to think about it, because for the good thing about stock market especially is that you can buy in small bits, right? So you can buy here, but you cannot buy a handbag in small bits, right? You have to get it on offer and make sure you get it. You cannot buy a house in small bits really, except REITs, but that's my recommendation to you. Yeah. So in the same way, I see some questions about, should I switch to China? Should I switch to Europe? I'll say this, it's very hard to guess these things. Whether or not a region goes up or down is not, firstly, it's not dependent on its economy. In the long term, yes. But in when the stock market, it really doesn't translate. I mean, Hui Jing, you know, the China market has been, the China economy has been having such great potential for years, but it doesn't translate into the stock market, right? Exactly. There's so many things.
Portfolio is down 40 to 50%.
Yeah. So the China, the last few years has actually done quite poorly, and some very big funds have thought about it. And it's always this a China year, this China year. I think last year at some point it did recover quite well. But that is there's certain risks when you want to bet on individual countries. It's the same with the US, right? So up to last year, everyone's saying US exceptionalism, so go and buy the US. Why not consider buying, in that sense, the world, and let the accept the average return of the markets? I think now the temptation is going to chase Europe.
Yes.
can change Europe, right? And the markets move very, very fast, right? And you never know what happens when Trump does his next thing. So I would suggest to you, really diversify, and when it comes to the what you buy and also when you buy.
I think there's also another question that's quite interesting. They're asking if we think that the US economy or market will recover, because now nobody believes that US is a trusted partner.
Yeah. I think that there's definitely a broken trust in this, what's happened. And it's not just in the area of markets, it's also in the area of geopolitics, security, and defense. So obviously this is very close to my heart because I started my life as a defense policy officer in MINDEF. But I think that the US is ultimately, we believe that it should be more than one person. And what has happened in the last few weeks, especially when the markets came in, you did see that there's enough people who can be around to make a difference to that. And what will happen now, I believe, is that there will be a tilting away from the US as people diversify the sources of everything, security and all that. So you've seen already in Europe that Germany, of all places, remilitarizing. I mean, that's quite amazing, right? So so maybe that's good, because there'll be more security in that area. There'll be new structures that will be there. So will the US be slowly declining, and will the US dollar be dethroned? I think the answer is probably yes, because it's broken that trust. But I don't think, as I said just now, it will be immediate or fast, because they'll be shooting yourself in the foot. Yeah.
And I think we also see that, a lot of countries are also accumulating gold instead of just holding on to US treasuries. So I think there's actually a question in the Q&A asking, do you see this trend continue, whereby countries diversify away from US dollars as the reserve currency?
Yes. I think yes. I mean, it's already, just now I showed that we've already had quite a big shift over the last 7 years or so. All right, by I think it was 7% or something. But you can't do that immediately. Right? So even when the UK, the sterling pound lost its reserve currencies, it took some time. And even today, the sterling is still a major currency. Now, gold, I don't know whether there's enough gold in the world. It's the same with Swiss franc. Swiss franc is one of those safe havens, but there is not enough Swiss franc in the world. So or euro for now. So I think the diversification has taken place. It might accelerate a bit more, but just think about it. You have it on balance sheet. You want to sell this thing, but you don't want to sell all at one go, because if you sell all at one go, firstly
the price will
price drop, and then what are you going to buy,
south.
right? So gold is very interesting, because gold has many properties, and but gold can be taken away by governments. Gold and silver. And it has happened a lot in during the Chinese Revolution. I think it was illegal to actually keep silver and gold. And just now I alluded to it, that they left the gold standard, right? So effectively, we are saying that we want governments want you to believe in the currency that is being issued. So I think the short answer is yes, but not suddenly and not quickly.
Yeah. And speaking of gold, we have some investors thinking of buying to gold as well, because the headline news now that you hear is Trump has actually, tweet about certain things that actually cause the market to be volatile, and oil prices actually, coming down lower, gold hitting record high, and they're thinking, should I actually diversify my portfolio to buy more gold?
Yeah. Okay. In our portfolios, we don't have a strategic allocation to gold. Yeah, so gold is a different kind of asset class that is I was call it an asset class of emotion. And while gold has some uses, jewelry and all that, the main price is being whacked by speculation, or by financial investors, right? So You can buy some, of course, but you know that it's run up quite a lot. And it's basically you're taking a bet that how far would it go? And I think the other question I asked you is, when are you going to sell? Right? Because ultimately you're buying paper gold, right? You're buying paper gold. So gold has no economic and you're not buying little bits of gold such that you're going to be a refugee and going to trade it for gold. Yeah. That is actually really what gold is supposed to be, right?
And jewelries are not included.
Jewelry not included. Yeah, and like I bought a little gold coin some years ago, and then I gave it to my son, and then he went to open it up from the UOB the thing, and apparently that makes it a little bit harder to verify.
Yes.
Yeah, so gold has when you even buy physical gold, there are problems with storage and all that. And gold is actually what we call negative yield, or no, there's no yield. Whereas stocks and bonds actually represent economic activity and all that. So that's why you see that in the end, the big pension funds of the world, they might allocate something to alternatives and gold, but it will never be big because they are not the core of what the participating in global growth is, right? So maybe if it was a depression as a central scenario, as in 2008 at that point, some people said it was, then you're talking about gold and canned food, but you're talking about extreme situations. And I do believe that we have enough wherewithal in the governments of the world to prevent that. Yeah. So if you want to, yes, a little bit, but don't I think let's not overdo it and don't give up on the human enterprise.
Yeah.
Yeah.
So when you say a little bit, does that mean like 5%, 10%?
That's fine. I mean, it's really up to you, right? On what makes you so happy. But I'll say that if I've never seen an institutional portfolio go like anything like beyond 5 or yeah, because it doesn't yield anything on a normal basis, a day-to-day basis. Yeah.
Yeah, true. So we also have some investors who are diehard T-bill investors, but they are concerned that T-bills yield has dropped drastically. And should they continue to stick to T-bills that has been serving them well for the past couple of years, or should they diversify? And this is actually a retiree asking this question.
Yeah, so I think for retirees in particular, more so than others, right? You start from your needs. So we always say that you start with CPF, right? And CPF can give you the safe retirement income floor. So if you're a Singaporean, one of the things that you could do is that you could do a little bit of a housing refund into your CPF OA. So this is if you have used CPF to pay your house. You can actually separate from anything else that you might do with CPF Life, the annuity. You can actually return some of your CPF into OA, and that's 2.5%. So that's one option. So if T-bills go below that, then it might be the case. I think it's getting quite close to that.
It is.
Ultimately, in such situations, you actually don't have very much. You can't really depend on T-bills, and it was only in the last few years that was a bit that when interest rates are higher, that this helped you. Of course, you could buy in individual bonds, or you could go a little bit longer duration and then just clip the coupon. But it's a little bit more difficult to buy the bond funds if you don't because you will see the asset value go up and down on that. So there's no easy answer that if you're going to want to have no risk or almost risk free and very liquid, then the return will be low. Yeah.
I think there are also more investors actually asking what should they do to their portfolio at this point of time. Should they actually sell their global equity position and move everything into bonds or bond funds? Yeah. Is this the right time to do so?
So again, there's that is, I think, not the starting point that I would ask of you. The starting point is like, what is your need, and what is your risk appetite, and what is your time horizon. You have to start from there, right? Because it might be right for you for one person, it might not be right for another person. Because if you're asking me whether or not bonds will now recover and go up versus the the equities, that is really something I cannot answer because everything is unpredictable, and that's really timing the market. It doesn't make sense. So you need to know that what is your time horizon that you're looking for, what is your need, and what is your willingness to take risks. If you don't think that you can take the equities going down 50%, and you don't actually need that return, you are quite happy to take a smaller return, then by all means you should do that. But don't take it lightly also, because if you're trying to say that, okay, let me time it this way, that way, again, you might very much get it wrong. It really, what you should be doing is to stay invested in something you can stay invested in, and you're happy enough for it to ride through, with your time horizon being the most important thing.
Yeah, I think we do have quite a lot of Singaporeans with some cash on hand, and some of them, given the market condition, they are not comfortable to go into the market. So we have this one of our investors asking, since I have money on hand, should I pay down my housing loan or top up my CPF since market is so volatile?
Yeah,
It's quite an interesting question.
I do not know what age this friend is here. I think that you can, again, everything that you do, I recommend you do slowly and steadily, especially if it's extra money, right? Yeah. So there's no real need to say do it all at once, and please be aware of certain things. You top up your CPF. Okay, I assume that you are. If you are below 55, you're topping up, it goes in 1 week and come out. Okay, you top up your special account. Very good idea. It's a very good idea. You know, I really, but will you need that cash? Will cash ever become precious to you? If same with paying down housing loan. I've perhaps this is a bit unorthodox, but I've never been a very big fan of paying down housing loan.
Oh, why?
Yeah, because it's
debt-free, isn't it good?
But you see, you're changing your liquid asset into a illiquid asset.
Oh.
Yeah. So you know definitively you're going to save forever 2.6% or something, right? But there is actually an option for you to invest long term. So if you tell me that you can actually lock this up in your housing loan, and your housing loan is another 15 years, then actually, and this is excess cash, then actually maybe you should go into the market, right? Into a suitable portfolio that housing debt is actually what we call good debt, because you know, debt is like the reverse of a bond. You know, you just keep paying only the same thing, and it goes down. The value of that goes down over time because of inflation, right? What you're paying, and so why don't you take that and start invest a little bit into a suitable portfolio, right? CPF, very good idea if you realize that you this is where your risk appetite is, because it gives you 4, 5, 6%. But again, it's all about liquidity, right? Again, you're transforming something liquid into illiquid. If you are working, if you are still not having expenses to pay and all that, actually I wouldn't think twice about not preserving cash. I'd rather take a lower return if you don't want to invest, or you take a little bit of risk, because whatever is a stock, right? Even if it goes down 5% and you need the money at the time, you can withdraw. If you put it into CPF special account, you can't. But of course, if it's for the long term, if you're building long term asset, then do it. And of course, if you cannot sleep at night, if you have a housing loan, then and you have really excess cash, you can consider that as well.
Yeah, especially now that I think the economy is slowing down because of the tariff situation. A lot of people are thinking of actually holding on to some cash rather than locking them up. Yeah, so keeping some cash on hand will definitely be useful. Yeah, if, for example, during rainy days or during retrenchment.
You can't tell. You know, it was already a very difficult situation with AI and all that coming up. So 3 to 6 months is the basic financial planning guide. We've always said that it's not good enough, because we always think it's reached 6 to 9. In today's situation, perhaps even maybe even up to 12. Yeah, so consider that Yeah, and of course, there's also Singapore savings bonds as well. There you can keep your cash and it's flexible, so you earn a little bit, and then but you can always redeem them within like maximum 28 days. Yeah.
Sounds like keeping a diversified portfolio is the way to go. Holding some in cash, some into the investments, assets like bonds,
Yeah, I
equities.
would say it more like I see it more like having different portfolios, like different buckets. So one bucket is really for your needs, and this is good to keep near-term needs of 1, maybe 2 years even. And for retirees, if what you have as a pot is enough, right, you might as well immunize the thing now, and then that helps you to avoid this what we call sequence of returns. We don't have time to go into that, but you can look at our I think second video, for some explanation on that. Yeah.
Yeah. So we also have an investor who has been very disciplined. She doesn't believe in actually holding cash, putting cash in the bank account. And what she has been doing is she has been putting money into the markets. And in February, when she got her bonus, she actually put a sizable amount into the equity markets. And we know that February was actually at the peak of the market, and she has actually suffered as a result in terms of the returns.
Yeah.
So as a retail investor, she has been sensible. When she has the money, she will deploy into the market, she stay invested. But somehow or another, this consistent investing strategy actually yield her bad results like what she has seen now. She's down about 10%. What should she do? Is this still a right approach, DCA, dollar cost averaging?
Yes, if I assume that you are still in your time horizon, you don't have to participate in looking at your portfolio every day. Right? So this is exactly it is the correct approach to take. What is perhaps is a bit unfortunate. I mean, that is of course risk. That is the price of investing, right? You get a return. It means that some years will be down, some years will be up, but over the long run, things do recover, as we have said, right? So take a look again, and if everything else has not changed, especially your time horizon, perhaps what you can do is that you accept that this is that short-term fluctuation that does happen. In the pure equities market, things can go down 40-50%. Right? And if you're invested in the whole market, that's okay. If you're invested in individual stocks, then that's quite a different thing, right? So 10% is dare I say, not so bad because during the crisis it can go down further, right? So if it makes sense for you, for your own psyche and all that, you might want to maybe take a pause and see whether it's something that is suitable for you, right? And I do not know whether you're globally diversified. If you are, then I don't think you have very much of a worry over the long term. You take a very long term view.
And what about dividend investing? Singaporeans love income. We have an investor over here asking, should I buy into a fund that actually offers me high income payout? Yeah. Would that actually help me to accumulate passive income over the years?
If you're still accumulating in the accumulation mode, that means you're not using it to withdraw. Actually, the dividends are just a feature. There's no more, no less. Companies pay dividends, and then you have to reinvest them on your own if you receive the dividends in cash. The dividends are good for your psyche because you feel that you're getting something back now. But we have many people who will receive the dividends, but actually they don't need them. So then they have to find some way to redeploy them, right? So the downside, so the good side about dividends, that dividend stocks also tend to be a value stock. So it's you're not so subject to all these the growth risk and all that. But at the same time, dividend stocks will you might be from a smaller pool, right? So for example, REITs, right? REITs are the classic high dividend stocks. And I think Singaporeans love REITs, and it's not a bad idea because as long as the underlying is good, right? Somehow people can stay invested in REITs. They can't they find it very hard to stay invested in the whole global index. So it's like, okay, fine, you like the asset class, maybe kind of like 30% to that would be quite good. So if the dividends help you to stay invested and they are in good quality companies, then you have a lot of confidence that these are good quality companies. Then yes, do that. But as I showed you just now, there are so-called blue chips that have taken a very long time to recover. So if you go for dividend investing, do diversify as much as possible. Yeah.
Okay. Yeah. So I think there's also a question asking about, MoneyOwl's initiative to launch the Amundi passive funds with Philip. Yeah. And they would like to ask, why Amundi and why not the other houses? Why do you actually launch passive funds and not active funds? Yeah.
Okay. Maybe a bit of a long. I'm not sure I can answer that all, but you can also download we have an investment philosophy ebook, but very very quickly, passive funds are basically funds that buy the whole market or big enough markets, but we don't just say passive meaning a technology index or whatever, right? There's still a very small basket. Think of it as a very big basket of goods. It's like the whole world. We're buying the world. So we have a world fund, we have a US funds, and what you're doing is that you're going with the wisdom of the whole world when you do that. And that's what a globally diversified passive fund does. And in Singapore, Amundi is one of the few that has and definitely the lowest cost passive funds there. So active funds, there are a few issues. One of the major issues is the cost, and this you talk about it in terms of expense ratio, because active funds, you need to pay a lot of analysts, fund managers in order to do that. So every 1% in cost that you pay is 1% lost to you compounded, right? So that's why we try to keep the cost low, and passive funds tend to be less costly by far. The Amundi funds that we have, the US one is 0.05% per annum total expense ratio, or 0.10% for the global funds. Now, the other question is about strategy. Just now I've shown you about market timing, and we have a lot of data that shows that the report card of active fund managers in terms of the performance has actually most active fund managers don't manage to beat the market, because stock picking is not easy. It's not that it's impossible, it's just not easy to do it. And if you do beat the market in one time frame, you can't do it consistently. So for these two reasons, we just go with the market.
And it
keep
doesn't help
simple.
with Trump,
And
who
of
is
course, it
so
doesn't help when you come back.
unpredictable.
Yeah,
Yes.
correct. Yeah. So that's why I said average your bets, right? When people are gambling with the world and gambling with your sanity, you don't gamble that way, right? You don't place your bets like that. You average out your bets to the world.
Yeah. So we have an investor over here who actually, I think, because now at 55 years old, your SE account will be closed and will be transferred to retirement account. So they're thinking, why should I actually start investing my CPF monies first rather than let it sweep into my retirement account? Because by doing so, I will be able to keep my money in the CPF OA and get higher returns. If I were to sweep everything into retirement account, moving to CPF Life, I will not be able to get excess returns. Whatever that I can get is if I were to die early, and I will just lose out on the returns.
Okay, that's a little bit complicated because it's I'm not sure that there might be some misunderstandings about what you get back and what you don't get back, in terms of your legacy, because it's not that you only, if you die, your nominees don't get back things, right? So that can I suggest that you take a look at our CPF. We have a CPF webinar. When I talk about these things, there is the general idea is that use CPF Life, your retirement account, to establish a base safe retirement income floor to at least full retirement sum. That's our recommendation, to give you that income that will not fluctuate no matter what in terms of investing. And then everything else, then you can talk about it. I think if anything, I actually think that this you should take the 2.5% ordinary account as a very high hurdle rate now, because risk has increased so much. I would think you need to have the correct risk appetite to take it, because one is risk-free and guaranteed by the government, in fact guaranteed in legislation, 2.5%, and it's not too shabby. Right? So that's the
And I think we're coming to the end of the webinar, so we'll take one last question. And I think there's still quite a number of questions about Trump and what would happen after the 90 days tariff is lifted. So remember the other day we were having this conversation about the last day of the 90 days tariff is actually on Independence Day.
Oh, is it? Okay.
Yes. So what should investors look out for, and what should they do in the meantime?
I think really it's the same thing, to hang in there, right? Don't look for remember the 7 steps of Trump's thing, right? It's going to be the pendulum. It's going to be we were saying a roti prata, and all that. Yeah.
So when they send the note about, it'll be a pause. I'm
Yes,
not trying to fire them.
yeah. So this is the pattern, right? So please, I think we can't really read these things in the geopolitics. It will take time, and it's not just 90 days. Would that be a big deal that's done? I think I said in one of my webinar, one of my videos, that look for a prototype. Look for a prototype that someone can say, let's say Japan. Would make prototype. Does it really resolve? Then will probably, if that's so, then I think we'll have quite a bit of a relief. But of course, it's about China, and then it's about the flow through. Then it's about whether or not, it doesn't mean that your Nvidias and all that will recover, right? Because there's already some damage that's being done to the economy. But so again, I think let's take the actions that work for you throughout all these scenarios, rather than having to be always looking and trying to read it one way or another, because as we have seen, it changes day to day, right? So I think that's what we recommend, that hang in there according to your need, ability, and willingness to take risk, according to what works for you, and not be driven by the news headlines or guesses on how it would turn out.
So Chuin Ting, based on what I've gathered from this Q&A session, it sounds like what investors should do is to make sure that you have some spare cash on hand, preferably up to 1 year, or if you have the ability, even up to 2 years, because of the uncertain market condition or economic environment.
More the economic environment.
Yes. Yeah. 2 is to stay diversified, stay invested, and not trying to time the market.
Yes.
Yes.
But be very self-aware that if you know that you can't, then take advantage of this situation to maybe move to safety. Yeah.
Which is to reevaluate your investment objective, and also to decide if this is the kind of risk that you are able to take.
That's right.
Yeah. So these 3 key points.
Yeah.
Yeah. So maybe as we wrap up our webinar, Chuin Ting, do you have any?
I wanted to share
with us?
this little experience over the weekend I had of playing Monopoly with my daughter. So we have So in Monopoly you go around and around, and then so I was playing with my 9-year-old. That's her here, and as you can see, she's won the game. Right, I had too much cash, not enough property, and my husband had was over invested in 2 property spaces and not enough cash, right? And when we landed in the jail, actually we're quite happy to be there, because we thought, can we just stay there, then we don't need to get up and land on, you can see, those scary color that she owns. But in Monopoly, you can't. You have to get up within 3 tries or 3 rolls of the dice, or you have to pay $500 and you have to run. Now, that is the life of a fund manager. Unfortunately, that's the life of a trader. You have no choice. You cannot stay somewhere and just wait for it out. But we are not like that, right? We are you just need to look to your goals. You don't need to try to guess it, right? You don't need to throw the dice when it comes to playing the game that wins, right? Which is actually not a game, but it is your life goals and all that. So you don't have to guess when the market. You can average your bets. You don't have to guess when it's going to happen. You don't have to guess when Trump will do this or Trump will do that. You don't have to guess what the Fed will do, and you don't have to guess the timing at which things turn around, or what companies will benefit what. You don't even have to play the game, right? So in fact, you can live your life and go and take your kid out to play a fake money game, or and go to the pool or something. Yeah. So markets are not the world. They shouldn't be. You should be invested in something that you can stay invested in, because your life is so much more important, with many more important things. And so I encourage you to not be stressing over markets so much, as long as it fits your needs, is sufficient for you. The sufficiency and reliability is really a very, very big, precious thing that you can aim for, and it's not too little. Yeah. So focus on yourself and focus on your life.
Thank you, Chuin Ting. So we have come to the end of our webinar. So if you'd like to get a copy of the presentation slides, please scan the QR code over here and we will send you the presentation slides. And please actually visit our website, whereby we have a lot of interesting information there that's very informative, helping you to actually learn more about your investment needs. We have investment checklists as well as curated investment solutions there that you can actually look at and seek reference and be a smart investor. So subscribe to our mailing list, access to our advice, get notified on webinars, and keep yourself updated with news and events. Besides that, if you have more questions to ask after this webinar, do ask them in our Telegram chat. We do have quite an active Telegram group whereby people actually ask a lot of questions about their CPF, investments, as well as their insurance needs. So please feel free to actually ask questions in our Money Hour chats on Telegram.